maybe the stock market crash might not be over just yet here, folks. The entire markets are in a calamity today based off of CPI data we're going to brief into, but more particularly, I want to talk more about the real estate market in places where bubbles are formulating in a way that are going to affect the likes of Amazon. We're going to be hearing from JP Morgan CEO Jamie Dimon, who kind of is speculating these really bad storm clouds are formulating on the horizon. He doesn't know how bad they're going to hit us, but it could be absolutely detrimental. I'm saying that correctly. We're going to be hearing from Patrick Bet-David, this massive insurance mogul that runs the YouTube channel Valuetainment. He has been one of the biggest bears. He thinks we're heading into a full-blown calamity, but he does offer some very insightful stuff on what you can do today just to protect yourself. And then finally, I'm going to give you my own opinion and show you aspects of the market that are showing signs that we could still be seeing a bottom. Now, this is a conversation you can appreciate. Damn it, hit that like button, folks. This is going to be an extremely long, intense, very data-driven video. Now, first and foremost, CPI data is still being driven by the same thing we've talked about in the past. All of it is directly related to oil. Oil drives the entire economy. If oil is continuing to go up in cost, we're going to see food, housing, every aspect of the economy get absolutely devastated here, right? So when we take a look at the May data that came in well above expectations here at 8.6%, guys, fuel and oil, take a look at this, 16.9% for May of 2022 is what it is up, just about as high as it was back in March of 2022. Now that is horrifying, and oil is completely driven by policy. They can fix this sooner or later, but it really comes down to whether policy is going to allow these oil conglomerates to start really driving into wells, which really kind of ticks off some of those, those green bugs out there, this whole renewable future that we've been fighting for. But Jamie Dimon made a great point we're going to hear a little later on about that. If oil doesn't start to cool off, a lot of other countries will go to cheaper fuels that cause more carbon emissions like coal. But nonetheless, this is where we sit. There's not much you can say about it, and the stock market is not taking it very lightly here. I mean, just take a look at this. Bitcoin's down 5%, the S&P down upwards of 3% today, the Qs are down 3.5%, and the entire market's just getting devastated. But again, I'm going to explain to you at the end of this video why it might not be as bad as it looks like it is today specifically. Now, however, let's get into the real estate market here, guys. I've been telling you I wanted to short the Canadian real estate market, finding ways to short aspects, particularly the speculative aspects, whether we're talking about residential development, those flippers, because with volume in real estate drying up right now, with obviously the inflation data going to force interest rates to go higher than anticipated, one of the scariest things I've noticed so far is that Amazon has quietly axed millions of square feet of warehousing space. This is insane here, guys. Basically, Amazon has canceled plans for nearly 10 million square feet of warehouse space, shelving plans for more than a dozen fulfillment centers and delivery facilities around the U.S. as the company wrestles with costly space glut and the heels of the pandemic, right? And this is something that was one of the greatest growth real estate aspects of the real estate market when we're talking about things like Stag Industrial, because one of Stag's the largest client of Stag was Amazon, right? And you have to think with the logistics problems, people were getting extra warehousing space just to double up the volume of product so they wouldn't have to deal with waiting to get product. And maybe this was a hint, because that article didn't come out till relatively recently. And when you take a look at Stag, guys, it has been falling off. I feel like there's some insider news going on right now, and somebody's caught wind of this and they just started selling out of these industrial REITs. So maybe another aspect of the real estate market to short. But I got a lot of this information. I got to give credit to Financial Education Jeremy here, because he actually went out into Phoenix, Arizona and drove around and actually looked at all these warehouses that were going up. And it was insane, guys. Insane. A lot of these aren't finished, and the ones that are finished, there was nothing going on in those areas. So I'm really concerned for the e-commerce space and how this could affect Amazon's next quarterly reports. So this is something in the real estate market to pay close attention to. Now, from the Canadian aspect of things, I'm going to state that if we're going to see a real correction in real estate, the Canadian market will be largely the most hit, and that is because it is a growth-based market. It does not run off cap rates. You're not buying a rental unit here really cash flowing positively, because again, guys, the average home in Ontario is over $1 million right now. So somebody shared this with me, really incredible. The Beta Pro Equal Weight Canadian REIT minus 2x Daily Bear ETF, which is one hell of a mouthful, but it is basically shorting the broader Canadian REIT index. Now, preferably, that is a scary way, in my opinion, to short the Canadian real estate market, because some of those REITs still have relatively robust balance sheet, good tenants, so they might not be hit as dramatically, but still, they're holding things like Granite Real Estate Investment Trust and a lot of the REITs that could get kind of hammered. So this could be a fun way to short the real estate market. I'm not sure if I'm going to take some shares in this, but honestly, guys, I don't know how it wouldn't affect the upper REITs, because as interest rates go up, they can't really buy, flip, sell in the same manner they might have used to. A lot of issues coming into play here. So these short ETFs are very, very fascinating. Now, we're going to hear from Jamie Dimon here in a second, but if you want to support the channel, learn more about the real estate market, I've partnered with a multi-millionaire. I do interviews with him on this channel, and he's been releasing a lot of fun articles on this real estate bubble that is bursting. You can support the channel at absolutely zero cost to you. I make a few bucks for everyone that signs up. You just put your email in, get these articles, really incredible stuff. I absolutely love Wealth Research Group, and I'm going to continue supporting them on this channel. Now, JP Morgan Chase here, guys. Whew, man, I only took clips of this. Take a listen because it's kind of scary.
So those three things, fiscally induced growth, QT, Ukraine war. So I'm going to change the storm clouds out there because I'm an optimist. I said there's storm clouds, they're big storm clouds, it's a hurricane. Right now it's kind of sunny, things are doing fine. Everyone thinks the Fed can handle this. That hurricane is right out there down the road coming our way. We just don't know if it's a minor one or Superstorm Sandy or Sandy or Andrew or something like that. And you better brace yourself. So JP Morgan is bracing ourselves, and we're going to be very conservative in our balance sheet on with all this capital uncertainty. We're going to have to take actions, and I kind of want to shed non-operating deposits again, which we can do in size, to protect ourselves so we can serve clients in bad times. And so that's the environment we're dealing with. And I think it's okay to hope that'll end up okay. I hope it. That's my Goldilocks. I hope. Who the hell knows?
Now, Jamie really put into the perspective of these unprecedented times that we are currently experiencing with QT, quantitative tightening, quantitative easing, stuff that we've never seen in the economy before, with this geopolitical event going on that's having ramifications in the commodity market, from everything from food to fuels. And he doesn't know what exactly is going to happen here, because it looks like we're seeing a major hurricane form on the horizon, but we don't know what that's going to look like when it finally hits the shore, because there's always some good positive data that we didn't see back during the 1980s era, the dot-com 2008. It's really unusual because jobs are really good and income is still really good, but that could largely get hit if companies start seeing more and more pains at the scale. And again, the likes of Amazon could see as a hint with that slowing down, and obviously the logistics centers. I mean, this could be the first quarter ever where we see Amazon see a slowdown since their history in e-commerce, and that might be very devastating, not only to the stock, which I still think is largely overvalued. I'd love to buy Amazon just at a much better price, but obviously that could have much larger implications on the general market. Now, here we go, guys, because I want to talk about what you can do today to protect yourself, because first and foremost, it looks like the S&P, let me refresh this just to see where we're at right now, because on a month-over-month basis, it looks like we're just heading back to the lows that we saw at the beginning of this month here, guys. So we're not seeing like a drastic major sell-off, but this has been kind of a slow, painful bleed. So we could start seeing new lows in the S&P 500 here, but I want to just scale out a little bit here, and we're going to hear from Patrick David. I don't like his bearish sentiment. He's running around screaming the sky is falling, and he could very potentially be right, but I only took one clip of this 40-minute video that I think is by far the most insightful. So we'll break this down in parts and offer some commentary along the way.
So eight ways to prepare for a market crash. Number one, anticipation. We talked about it earlier. Number two, risk tolerance. Have a sit down with you and your wife or your husband or your family and say, what is my risk tolerance? At what level am I willing to risk a little bit? Because this is a season that if you're able to manage your risk properly, you can really come out stronger afterwards. But don't make any moves if you can't tolerate risk based on your age, based on your tolerance period, like yours. You may say, I'm not the kind of guy that likes this, and don't play around if it's not part of your DNA. But if you...
So when he's talking about risk tolerance, this is something that I try and talk about a lot, because most people are completely clueless. Sometimes they over leverage themselves in risk. If you're sitting on $500,000, $1 million, there's no way, there's nothing intelligent about just throwing all of that in the market today, even if it's just index funds. Making a proponented cash position and just being aware that we don't know what the future looks like, and having that opportunity and not losing that cost or that opportunity cost. People say cash is trash, but when we're looking at the markets down dramatically, I mean, cash might be getting getting hit at 8%, but if the markets are down 15, 20 plus percent, or small caps that are down 90%, your value of that cash is ever more exponential, right? Especially when you're looking for opportunities. And this is where gold and other things might become a little bit more proponented, but we'll talk more about that in a sec.
Sale today. Many have been preparing for this season to come. Cash will be king the next 24 months. Cash was not king the last 24 months. Cash will be king the next 24 months. Avoid any major real estate deals unless if you're going to be living in this house for 10 years. If you can avoid buying a house the next 6 to 12 months, I would do so. If you can. If you're going to live in it, great. If you're not going to live in it, hold off a little bit. You're probably going to buy it at a discounted rate.
Yeah, the real estate thing is huge because if inflation stays high, interest is going to go up higher than expected, and that is just going to detriment the entire real estate market. And it's better to see how the cards kind of fold out here because you might get a better deal in the future. And I don't think real estate will ever rebound as quickly as the stock market might. So watching it just kind of correct over the next 3, 6, 12 months might be a better option until the storm clouds settle out and you can start negotiating and just seeing what prices ended up settling to, because you don't want to buy a house right now, even though the prices have come down, to only see, all of a sudden interest rates jump dramatically and then real estate drop another 10 or 20%. I mean, just be patient with that.
6 to 12 months from now. Have a serious business plan in place. 5% precious metals. This may be a season where the people that are pro gold, people will have an argument. Oh, I told you gold has done this. Yeah, they may be right. Gold may hit 2,000, 2,500. So you may want to have a little bit of maybe 2 to 5% precious metals, and some of the crypto is going to probably recover. But, the precious metals may be something for you to look at, protect.
What I find really interesting here is not only does he mention gold, but the crypto markets. And this is a really intriguing ordeal that isn't even close to the similarities that we saw in the 1980s, right? Like, let me just pull this up real quick. First and foremost, the reason I think he mentions crypto and gold is because they're completely separated hedges from the market themselves. Even though they've been kind of correlating with what the market's doing, you kind of got to remember here that those are really particular assets that are designed to disconnect you from the current monetary policy and the government. So that's why people would run to those. But unlike the 1980s, gold, you would think on this news, would spike much more dramatically. Same with silver, and it's not. I don't think I would have ever anticipated gold or silver or the precious metal market to respond the way it is to this data. So this is nothing like the 1980s. Could it shoot up? Absolutely, nobody really knows, but it's so unusual to see this kind of price action in this current market environment, right? So let's just keep going on here. This gets interesting.
Your career. What I mean by protecting your career is the following. Whatever you're doing right now, recreate yourself today. Last 2 years, if you really improved, nobody noticed. Last 2 years, if you read a lot of books and you were the person that's sitting there taking courses and getting better and going to things, events and conferences, nobody noticed. Nobody noticed because people who didn't do that made money. So the market's like, oh, wow, look how smart that guy is. But you were working on yourself. Nobody noticed. But today, if you work on yourself to recreate yourself in your company with the way you show up, with your attitude, with being a person that's showing up, leading, working hard, improving, challenging your peers, setting the right example, constantly getting better, reading, bringing new ideas, bringing strategies, everyone's going to take notice the next 2 years. This is your season. The people that are in that mode of wanting to improve themselves, the next 2 years are your season. The last 2 years were not your season, just so you know. Number 8, take a time out and study your portfolio.
Okay, 2 things here, because take time out, study your portfolio, and protect your career. This is some stuff that's going to be absolutely critical, in my opinion, in the coming months, because most people have probably got a little lazy in this current boom market where everybody was making money hand over fist. But now if you're kind of up on your game here, you got to make people notice. I mean, you're going to have to come out on the other side of this stronger than we're going to go into this. So hopefully you're good from a career standpoint, but from a portfolio standpoint, I also think it's very crucial here to understand, again, coming back to that risk tolerance, just taking a look at your diversification. Do you have global diversification? Are you largely exposed to the US dollar and the US market? Talked about this a lot. One of the stupidest things I hear US people do, because I'm Canadian, I kind of got a global perspective and most of my money is spread out across multiple currencies and asset classes. People largely overlook the value of getting disconnected from the US dollar. Just because you're buying US equities, it's all converting to USD. That is not really the definition of diversification. And I feel like US people get lazy and they're like, oh, because I own McDonald's, it's globally diversified, but it's all connected in your portfolio to US dollars. You need to find a way to understand true diversification and, again, get out of just, maybe highly speculative investments, and make sure you have some energy and oil stocks, and make sure you have those aspects of the market that are doing slightly better. And I want to talk about that right now really quick here, because what people need to understand from a a market perspective is the market doesn't really care about CPI data. That is just personally individuals that are like, oh, I'm freaking out, the market's going to drop, we're going to sell, right? But inevitably, you know, with all the trillions of dollars that are constantly inflowing and outflowing of the market, you don't know exactly when the bottoms are going to happen. And what I find very unusual here is when we look at small caps. Now, small caps devastated. I kept saying that. What are small caps going to do? Drop 90% and then drop another 90% and be trading in pennies and go bankrupt? I don't see that happening, and I'm not seeing it now with the larger aspects of stocks finally getting hit. Real estate was the last domino to fall. When that gets hit, it'll offer a bit of a ripple through the market, but once that's done, I think we're done with this market correction. That's why I'm saying we're nearing the bottoms, because look at Palantir, guys. On a month-over-month basis, it's barely dropping today on the CPI data, and it's still up 12.6% month-over-month. Here's a completely random company I recently did sponsorship with here. Imix Biopharma is up 61%. SoFi is up 12.76%. Hyliion is up 19.39%. So it's very unusual now that small caps are not getting inflicted at the scale that they were, and now it's large caps that are getting inflicted. So when large caps finally start seeing their final day, I'm hoping that we start seeing that in the next quarter or two baked into that data. You know, maybe Amazon says, hey, e-commerce is slowing down. Boom, the stock's going to get hammered, hopefully for the last time. And same thing with Google, right? Like a lot of YouTubers are complaining right now about ad rates are basically dropping by upwards of 30%. I think we could see that starting to get largely inflicted on their balance sheet. So these large caps have a little bit more settling to do still. But again, I don't think there's anything wrong with starting to cost average into them here. Just be prepared that they could go lower, and make sure that, again, if you have a larger scale of capital, make sure you do got some cash just in case we do see a full-blown crash at any point in time, right? But again, doesn't mean that a crash is going to be coming around the corner. So personally for me here, like I said, I'm still just sitting on a bunch of cash. I should hopefully know what my cash position is going to look like. And yeah, I'm going to allocate and make sure I have a large emergency fund just in case. But I actually bought some S&P 500 yesterday. Should have waited till today just before the little bit of a tank. But I'm going to keep buying it as it goes lower, because again, we don't know what the market does, but over a long period of time, we 100% know that it is continuing to go up. And it's just a matter of riding through this current hurricane that is coming around the bend. So let me know what you think about all this in that comment section below. I'd love to hear from your wonderful mouths to my comment section. And also consider getting that link in the description below there, guys, for Wealth Research Group. They've been very awesome. Love working with them. So stay cool, stay awesome. And as always, I look forward to catching you in the next one.